to share some information and some strategies with you this evening. My name is Glenn Wagstaff. I am an attorney. Don't hold that against me. We help with everything related to estate planning, tax planning, asset protection planning, legacy planning, business planning, and that aspect of things. And tonight I have the special honor of John Shin, requesting that we share some thoughts with you guys. So we have a very special topic that we're going to talk about this evening. And this is a topic that I think is very valuable for this year, but also it's a topic that we have a very special announcement for everybody here at the end. So stay until the end because you're going to want to participate in this free giveaway that we're going to have for you before we finish. So by a raise of hands or send it in the chat, how many of you have been here before, and especially how many of you have been here before when I've presented some information in the past? Let us know here in the chat. I'm going to pull up my presentation for this evening. All right, I recognize a few names of people who have been here before. We've talked. I know a few people. I have a great relationship with this team and with this community, and especially looking forward to the conversation that we're going to have this evening. So, thanks for letting us know, everybody. A lot of times we have the privilege of being able to talk about topics that really affect families, that affect people, and that we can bring strategies to the marketplace to be able to assist them with. And tonight we're going to be talking about tax planning. So I don't know how many of you guys are involved with tax planning for your clients, or how many of you have had the opportunity to bring up tax planning strategies with your clients, or maybe for yourselves, right? But there are many situations where tax planning becomes ultra important. I know a lot of you are here from California, right? I saw it in the chat earlier. And if you're in California, you get killed in taxes. It's just a fact, right? And so some of the things we're going to talk about today apply to income tax planning. Some of them apply to capital gains tax planning. And some of them apply to estate tax planning. But where we're going to spend most of our time this evening is in what we call capital gains tax planning, or planning for exit taxes. Now, what exactly does exit taxes mean? Have any of you heard that word, planning for an exit, before? When we talk about an exit, we're talking about either a property or a business that you exit from. You sell, you liquidate, and because of that, transaction, you're exposed to tax. So let me share a quick story with you guys. In 2022, at the very end of the year, this was like December 16th, and we got a phone call from a guy who had been referred to us by a brand new insurance agent who had just started in the industry, and he was working with a church, and his pastor said, we have one of our large donors, and he'd like to donate quite a bit of money to the church, and he's going to be paying a lot of taxes. And I told him there was a way that maybe we could, get him more tax savings, more tax benefits. And so I said that he should talk to you. So, he set up a meeting. We talked to this guy, and he had already met with 3 different financial teams from very big brokerages, big organizations. Like one of them was Wells Fargo Advisors. Another one was I don't remember the name. I don't want to say the wrong name, right? But very, very big, well-known, established institutions, brokerages, right? And most of the time, we would think that they would have solutions for him, because he exited from a $1 billion business, billion with a B. That means that his portion of the business, he didn't tell me exactly how much he owned because he wanted to keep it more confidential, and we didn't really know each other at the time. But his portion was over $500 million of value because he was the primary shareholder. When he sold that in the state of California, he was subject to capital gains taxes. That means everything that grew from his initial investment in the business, which was next to nothing because, most business owners, we start the business, we put money in as we go, we kind of build it up with revenues. And so it's called bootstrapping, right? And so he had put in very little in the way of capital up front, and he had grown this massive business that was now being sold for $1 billion. And so he had close to $250 million of tax liability that he was going to have to pay. Now, he had met with 3 different brokerages, 3 different tax teams, 3 different financial teams, and asked them what he should do about the taxes. And what do you think the answer they gave him was? Well, hopefully they would have given him strategies, right? Put in the chat if you guys think that they probably had strategies for him. Exactly. Michael, you're right on. What they said was just pay the tax. Now, it's easy for them to say, pay the tax. It's not their $200 million that they're going to be paid, right? But he wasn't really happy with that. He was looking for other solutions. But at the end of the day, he didn't get another, option. And finally, he was having a conversation with us. And so luckily, we were able to give him 3 different options at that point. And those 3 options, if he would have done any of them, would have saved him over $100 million in taxes. And what was his first question to us? I met with these 3 financial teams, established organizations. They have proven track records. Why didn't any of them tell me about this? What do you guys think the answer was? Well, they either didn't care enough, they didn't know enough, right? They didn't know what options were there for them, or they would have made more money by having him pay the tax for whatever reason. So what we're going to teach you tonight is how to address those situations and how to help people avoid tax in those situations. So I finally got my presentation up. So this is a little bit about us. We are LSPN Direct. I'm the principal managing partner, founder of LSPN. We have over 140 attorneys across the United States. We've been recognized with over 50 international awards as the best estate planning network in the country. We have licenses in over 42 states and an expanded network to cover all 50 states. And we have professionals that speak multiple languages, and we're here to serve you. And so, a lot of times we get requests for people that need to plan around their taxes. And it's not because they don't have an accountant or because they don't have a CPA. You might have an accountant or a CPA and still not get proactive tax planning. Why? Because most accountants, their job is to look backwards to what you did last year and to help you to essentially save as much as you can based on what was already done, what you already did last year, right? But it's like going into a restaurant and they give you a menu and you have to order from the menu. You only have certain things you can choose. So there's only so much your accountant can do after things are done, right? Most accountants never get to the point where they're doing proactive tax planning. That means that they're looking forward to next year and they're saying, okay, how do we restructure things? How do we avoid the tax that's going to be coming in the future and position things so that you can minimize the tax that you're going to be exposed to? That's what we call proactive tax planning. And most of the time, you either need a CPA that does proactive tax planning or you need a tax attorney. And that's where we come in, right? So today we're going to talk a little bit about proactive tax planning, but specifically planning for an exit from property or from a business. So again, when it comes to income tax planning, you can find a good tax professional, CPA. They can help you to do the tax preparation. And if they're not doing a good enough job for you, then obviously, we have connections with professionals that can. But our approach to income tax planning is basically this. You start out with your gross income. And whatever you make, everything that you make, you have to declare, and then you have to be able to prove that it's either subject to tax or it's not subject to tax, right? And so those are, what are called legal deductions or exemptions, right? You have to go through the IRS code, and there's thousands of pages of IRS code. And so a good tax professional knows all the deduction opportunities, and they help you to maximize your deductions. And so what they're going to do is they're going to whittle down that gross income until you show the least amount of net income possible. And they do, what we call deduction planning to try to minimize your tax effect through deduction planning. Well, sometimes you're still showing too much in net income. So what do you do then? The next phase of income tax planning, right? Phase number 1 is what we call deduction planning. Phase number 2 is what we call entity structuring, which is, do you have the right entities in place? And by the way, if you're a W-2 employee, you only have a couple dozen deduction opportunities. But if you are a business owner, an independent contractor, or you're receiving income through a business, you have thousands of opportunities for deductions. So the easiest way for you to get into more options on the menu is to have a business. If you're not taking advantage of all the deductions available to you, then talk to your tax professional and they can help you to go through that, right? So the first step is deduction planning. The second step is entity formations or entity structuring. And when we set up those entities, the idea is for us to figure out where's the best place for that income to come from and how do we give you access to more deduction opportunities, right? We have to justify the purpose before you claim it. So it has to be in place before. You can't do it after the fact, right? And so if you're still showing too much income, then we engage in a process called income shifting, which is deciding which of those entities are going to declare the tax and putting things in the most tax favorable position possible. And then finally, if we need to go to the last step, which is what's called creating loss engines, then we create other entities that you can justify, getting big deductions through and claiming deductions through that are matching your lifestyle expenses that you're already spending. So when we get to entity formations and we're structuring these things, there are 3 major ways that we can funnel money out to save you money in taxes. We can put into place retirement strategies, which will avoid the taxes today. Maybe there's taxes later, maybe not, depending on the strategy. But usually, you avoid the taxes today, and then you're going to stay in a lower tax bracket when you do realize it, if it makes sense. The second option is asset protection strategies, right? Where we can put things in place to protect you better, but they're also tax deduction or tax shelters, right? Tax deduction opportunities for you to be able to reduce your overall tax effect. Or the third way is what we call charitable strategies. And that could be your own private foundation. It could be your own charitable trust, right? There's a lot of different things that you can do to be able to minimize your income taxes through charitable strategies. So we're not going to go into a lot of depth on the income tax planning side. I just mentioned it so that you guys are aware that that is something that we do. And at the end, we're going to mention also estate tax planning, because that's also something that we do. What we're going to spend most of our time on today is capital gains tax planning. So how does capital gains taxes work? Well, most people, think that all taxes are the same, right? You pay tax, it's all the same. But actually, there's a lot of different tax structures and tax schemes in the United States. So the income tax system has 2 parts. It has your regular income taxes on your income, and then it has capital gains taxes that you have to declare based on assets that realize a growth in value, right? So the longer you hold an asset, the more value it's going to gain, and then you have to realize the taxes on that. So for example, if I buy a house, and when I bought the house, it was worth $100,000, and then I hold it for 10 years, and at the end of the 10 years, it's worth $1 million. What I originally put into it is called my basis. And that part is exempt from being taxed. That's the money I put in. That's the seed, right? But when I harvest it, when I sell it, everything that comes from that seed that it grew into, now I have to pay the tax on that. And that's called the capital gain. It could be short-term capital gain if I hold it for less than a year, or it could be long-term capital gain if I hold it for longer than a year. But basically, the growth is going to be taxed at a different tax rate than your regular income. So short-term capital gains tax rates are pretty much the same as your ordinary income tax rates. But long-term capital gains tax rates are a little bit lower than your ordinary income tax rates. So if you're selling something minor, like, I don't know, you buy a comic book, and the comic book appreciates, and you've held it for a long time, and now it's worth $3,000, and you're like, oh, holy cow, I'm going to sell this. It's worth $3,000. I'm going to, cash out now, right? And so you sell your comic book for $3,000, and you bought it for, let's say, $3. Well, that is a gain, and it is a long-term capital gain. But when it goes, adding to your income, your long-term capital gains tax brackets are not going to change all that much, right? You're still going to be in the lowest tax bracket for long-term capital gains because it's only $3,000. For an individual, I don't think you jump out of the bottom bracket until you get up to, I think it's like 40,000 in capital gains. And then for a couple, it's like 78,000 before you jump to the next bracket. And so, you can keep your capital gains taxes pretty low on a federal level and even on a state level if you don't have very much in gains. Well, the issue is that most of us will have 1, 2, 3, maybe at most a half dozen exits in our lifetime that are big exits. So you sell a property, you sell a home, like in this example, you sell a home for $900,000 in gains. Well, that's different. That puts you in a completely different bracket. If you're in the state of California, for example, you max out at the top income bracket for capital gains taxes at 20% federal. In the past, it used to be even lower than that, but they've raised it. We have a huge deficit. The government has to make their money somehow, right? And so they raise taxes. So, at the federal rate, it maxes out at a 20% tax rate. But at a state income tax level, you have on top of that 20% in the state of California, you max out at, another, 13 to 15%. And then on top of that, you have Obamacare taxes that they put in place that those that are at the highest tax brackets have to supplement and pay more. So those are surtaxes that you get on top of your regular taxes. And I just heard just the other day, we were working with a client that was selling a property in Los Angeles. Los Angeles County put in place a new law that if you, and I don't know how many of you guys have heard this, if you live in LA, let me know if you're in LA, if you've heard about this. But they just put a law in place recently that if you sell a high valued asset, you have an extra 5% tax to the county on the exit. So you could be looking at somewhere around 40 to 42 at the highest level with the extra 5% from LA County, 47% taxes on your exit. Now that's a lot, right? I mean, that's almost half of what you're walking away from. And, most of the time people sell these properties and they're like, well, I got to buy a new home. I need that money, right? I can't afford to give it all to the government. So the question is, how do you avoid those taxes? And if you were to talk to a real estate agent and you're selling your home, for example, the real estate agent, most of them only know one strategy, which is what's called a 1031 exchange. A 1031 exchange basically says, well, you can take a property and you can sell it and then buy a new property. And as long as it's like kind to like kind, right? Similar properties, similar classifications and everything else, then you can avoid the tax because you're reinvesting into the same type of asset. That's an exception to the normal rule that says that you have to realize all the taxes up front. It allows you to defer it because it's under Section 1031 of the IRS code, right? The Internal Revenue Code. And that allows you to defer the tax until you do not qualify for a new 1031 or until you exit from the final property, and then you have to pay the tax. Why does the government allow you to do that? Because they want to incentivize people to have investments and to hold on to them. And they also want to allow for that money to grow more so that they can tax you more, right? So there's a reason to the madness, but that is one of the strategies available. And that's one of the most common that real estate professionals are aware of. But most people are not aware that there are a variety of strategies to avoid, defer, or minimize the tax when you exit from a property or from a business. So what we're going to share with you tonight is how I explain to somebody who's exiting from a property or from an asset what options they have. And some of you may have already heard this. Hopefully this is new for a lot of you. If this is valuable, let us know in the chat. But definitely want to provide as much value as possible this evening. And at the end, we're going to open it up for some question and answer. So feel free as we go, if you want to pop questions into the Q&A section, we'll try to address them before we finish up. So if somebody comes to me and they say, I just sold a business, or I'm selling my business, or I'm selling my property. We have a lady that we were talking with. She has 32 properties. She's 83 years old. She's getting too old to manage the property. She doesn't want to manage them anymore. And she thought that if she left all these properties to her children, that they would appreciate it. Well, the children do not appreciate it. She has 3 kids. One of them's an alcoholic. One of them is a stay-home mom. And one of them is a disabled veteran. And they don't have the time or the inclination to manage 32 properties. And the daughter has been, helping to manage the properties, but she's tired of it. She doesn't want to keep doing it, right? And so mom, wants to keep the properties, but she realizes that it's just not realistic, right? So now she's looking at exiting from 32 properties, and guess what? She's done 1031 exchanges over and over and over again, and now if she were to sell them all, she's going to have a ton of capital gains because she started with a small amount when she acquired all these properties, and now they've grown into a very large amount. So what does she do? We sit down with her, we have a conversation, and we said, okay, well, we have 3 options. We can either try to minimize the taxes through what we call tax minimization strategies. These are strategies that have to be put in place before the property is even under contract. So before you actually sell it, before it's even under contract, we have to put these strategies in place, and we can try to minimize the tax effect and avoid a lot of the taxes. So we'll get into some of those options, how those work, right? Then we said the second option is we can defer the tax. We don't have to pay the tax today. We can avoid having to pay it right away and pay it at some point in the future. And by the way, we don't have to do a 1031. We can, but we don't have to. We have other options. And then the third option is what's called a tax offset strategy. Oh, and by the way, the deferral option, the deferral strategies can be done all the way up until the date of the sale of the asset. Once it sells, then it's too late. But up until the date of the sale, and we've literally have had to help a couple clients do it the day of or the day before, right? So it can be done up until the date. We can do those deferral strategies. But even after the sale, we can still offset the taxes through tax offset strategies. So we're going to talk about each one of these, and we're going to give an example of each one and how it works. Fair enough? The first part, tax minimization. There's a few different strategies that work here. We can, for example, if you have a business and you are a C corporation and you establish it knowing that you're going to exit from it long term, right? There is something that the IRS calls founder stock exemptions, and you can exempt a certain number of or a certain value of your founder stock if you were one of the original owners and you held on to it for over 5 years. You can exempt it from taxes when you exit. Now, it can be a pretty large amount of exemption. It's actually $10 million that you get to exempt. So that's pretty good, right? But what if you exit from $1 billion company? Well, that's a drop in the bucket at that point, right? But there's also something called a Nevada Incomplete Non-Grantor Trust, or a NING. This strategy allows you to be able to compound founder stock exemptions. So you can get $10 million of exemption for each person in your family by setting up one of these trusts. That's one of the options. Another option could be a charitable LLC. Ever wonder how Mark Zuckerberg avoids a lot of the taxes on his holdings? Well, he actually has a charitable LLC that he holds a lot of his businesses in. How does it work? Well, you set up an LLC and the primary owner is a charity. You get to piggyback off of the charitable exemptions that they get, but there's a catch. They now own your company, or they now own your asset, right? And then within the LLC, if you want to pull money out, you have to pull it out as a loan and you have to pay it back. And if you pass away, then of course everything's going to go to the charity because they're the primary owner, right? Wrong. We set up a business succession plan for it with an exit, right? So we have a buy-sell agreement that will require that we can buy back the interest you gave to the charity, and we can even buy it back at a discount. But we do that with life insurance. So then they get paid out and the family gets to keep the asset. And it's a win-win, but you avoid a bunch of the taxes in the meantime, right? So I know these sound like cool strategies. I'm sure you guys have questions about them. Unfortunately, the one we're really going to focus on and go deeper into is called a charitable remainder trust. So the way a charitable remainder trust works is we can actually set up a trust where we put the asset into, and at the time that the asset sells, so let's say it's a real estate property, at the time that it sells, there's no tax. So you can have a highly appreciated asset, you put it into the charitable remainder trust, you sell it, and there's no capital gains tax on the sale. What's the catch? Well, the catch is that then the money has to stay in the trust. You don't own it anymore. And that trust earmarks it so that when you pass away, you and your spouse or whoever the beneficiaries are, when you pass away, everything that's in the trust is going to go to the charity of your choice. So it has to go to charity. But in the meantime, while you're alive, the trust is going to give you an income stream. So it will give you an income for the rest of your life. We can set it up for the rest of your life. We can set it up for the rest of your life and your spouse's life. We can set it up for a certain number of years so it can even continue, into your children's lives for a little bit if it makes better sense to do that based on the numbers. But some percentage of the value is going to be given to you as an income every single year until the trust runs out, right? And so that percentage has to be anywhere between 5 to 50% of the asset value every year. Well, how do we determine that? It's based on life expectancy tables. The IRS has life expectancy tables, and they determine how much is allowable, because at the end, you have to have at least 10 to 15% of the original amount still in the trust to go to charity based on IRS calculations. So the cool thing about these structures is not only do we avoid the tax, you get an income stream the rest of your life. And at the time that you pass away, if it was invested properly, you're outpacing that income that you're receiving. The charity's going to get the full amount. If you live for 20 years or longer, you're going to live off the full amount. And we can set it up in conjunction with a life insurance policy to replace the value, because the charity is going to get the value at the end when you pass away. We can replace the value through a life insurance for your family. So we took an asset that you would have had to pay 20%, 30%, 40% in taxes and keep the difference. And instead, we can allow the full amount to grow, and we tripled the value for you. Is that pretty cool? So we've done a lot of charitable remainder trusts over the last few years. For the right situation, it's an awesome strategy. For the right situation, it's basically like establishing your own personal pension for the rest of your life and leaving a charitable legacy to your family forever, and replacing the value with tax-free money that they receive through the life insurance. So it's a win-win-win. If you've done a charitable remainder trust or worked with a client that's done a charitable remainder trust, let us know. Let us know in the chat. This is one of those strategies that if you've never used it before, or if you know somebody who's exiting from a property and they've never heard of this before, you can be the hero. You can help them to save a lot of money, because this is one of those strategies that most people don't know about. So those are charitable remainder trusts. Again, if you have any questions about this, stick it in the question and answer box. We'll come back to it at the end. But this is one of the examples of tax minimization. When do we have to do this? Before you even have your property under contract, before the property sells. Does that make sense? So that's how tax minimization strategies work. Now, what about tax deferral strategies? If somebody says, well, that's not a good fit for me, or none of those options will work for my situation. Okay, well, let's look at deferring the tax. We don't have to pay the tax right now. We can look at other options. So the most traditional one is a 1031 exchange, where you take a property and you avoid the tax because you have to reinvest it in a like-kind property. But another option is what's called a Delaware statutory trust. We use Delaware statutory trusts as a safety net for somebody who misses the deadline or the guidelines to be able to do a 1031 exchange. Did you know that even if you want to do a 1031 exchange, even if you intended to, and you declared it, and you said, no, don't withhold any of my taxes on the sale because I'm doing a 1031, you have a certain number of days to complete your 1031 exchange. I believe it's 90 days. If you don't find a new property, then your 1031 fails. And if you don't go into the new property on the 1031, then you have to pay all the tax. And if you waited too long to declare it, you're going to have penalties as well. So a Delaware statutory trust, or a DST, allows you to go into a fund that's like a real estate fund instead of a new property. They manage it for you, and then you get the dividends and the returns. And it's like investing in real estate, except that you're not the owner of the real estate. They're investing it for you, they're managing it for you, and then you're just getting the returns on it. And you have to go in for 3 to 5 years minimum, but it basically meets all the same requirements as a 1031. It's a 1031 substitute, right? So there are options for that. And then my personal favorite is what we call an extended escrow trust. And there's a lot of firms and attorneys and stuff that do a form of this that they call a deferred sales trust. We don't use that name because there's a law firm that claims that they've trademarked and patented the deferred sales trust concept and blah, blah, blah. And we don't want to get in the middle of that because we came up with this without them. So our version is called the extended escrow trust. So how does it work? Basically, it's an option to be able to defer the tax when you exit from a sale of any kind of asset. And the tax code allows you to make your sale of an asset either an immediate sale, right? They pay you all the money up front, and you give them whatever the property or asset is, and it's an exchange, and you realize the tax immediately. But you can also do what's called an installment sale. How does that work? it basically works that for a certain number of years, you're making payments. And those payments only realize tax as received. So if you're the seller and you're receiving those payments, you're only realizing the tax when you receive them. That keeps you in a lower tax bracket, right? And so you can do an installment sale. Most of the time it's used when people don't have enough money to pay up front, or they can't qualify for a loan to pay up front. But what's the problem with an installment sale? If you're a professional, if you're a dentist or a chiropractor or a doctor or an attorney, you might have heard horror stories from your colleagues, right? Because the sale of professional practices, on average, when it's done as an installment sale, there's an 82% chance that there's going to be a problem with those payments. In other words, that there's going to be an interruption in payments, or that the sale is going to fail after payments were already started. So you're a doctor, you're retired, you're selling your practice. Big company comes in, or another practitioner comes in, they start making payments to you. They pay you for 3 years, and then they stop making payments. And you're like, what the heck? I was supposed to get paid for 10 years. And they're like, yeah, but the clients stopped coming, and we're closing down that location. And if you want to come after us, but it's just not worth it for us. Now you have to either go sue them and spend money trying to collect, or you take back over your practice and go back to work, and that wasn't what you wanted in the first place, right? 82% failure rate of installment sales for professional practice sales. That's crazy. So the downside to an installment sale is that you're not getting all the money up front. So what if you could do the best of both worlds? That's what an extended escrow trust allows you to do. The extended escrow trust says you purchase property, you as the buyer, pay the money in, but the money always goes to a third party before it comes to the seller anyway. That's called escrow, right? And the idea of escrow is ancient. It's based on the concept that an impartial third party, a neutral party, is going to, be in the middle of an exchange. So you give, whatever you're bartering, whatever you're trading, you give it to the neutral third party, and then they will give it to the other person, and vice versa, right? And so in this case, the money goes to escrow, and then the property goes, the title transfer happens, or the transfer of ownership or transfer of possession happens, right? And then the money's released. Well, how long does escrow have to last for? There's no law that says that it has to be immediate. It has to last for as long as it's reasonably necessary. Now, what if we establish a trust that says that the full amount is paid today, but actually it's not going to be paid to the seller today because there's conditions? It has to be paid over 10 years, or it has to be paid 20 years from now if certain conditions are met, or it has to be paid, a little bit every single year for the next 10 years and all of the rest at the end. We can put whatever terms we want to, but the money has all been given already, so there's no risk of default anymore. That's what an extended escrow trust does. So when we set up these plans, a lot of times we can set it up where we say, okay, we're going to defer the tax for 20 years. In the meantime, the money inside of the trust can be invested. It can grow. It can accumulate. You can put it somewhere where it's being put to work. You don't want it to just sit there. And while it's in the trust, you can actually even collateralize it. So we can actually take those funds. You can invest them, put them into annuities, put them into stocks, put them into bonds, put them into real estate. You could do a variety of different investments while it's in the trust. But you can also collateralize it. So you could say, okay, well, this money that's growing in my trust, I'm going to secure a loan with it from the bank, on what's called premium financing. And a premium finance loan is basically the bank saying, we're going to give you money to put into an insurance policy where that money can accumulate and grow tax-free. So they are going to fund the life insurance with the bank loan. And then that is going to grow over time. If you give it 20 years to grow, we can do the projections. We use very conservative numbers for these projections. We will know how many years it takes to pay back your loan, how many years it takes to pay back your loan and have a bunch of savings in there, how many years it takes to pay back your loan and have a bunch of savings, and have those savings grow to the point where they can actually pay your tax at the end of the 20 years when it needs to be paid. What if you could have $1 million that you would have normally had to pay 20%, 30%, 40% in taxes, and now you have that much less, and instead you take 100%, put it into your trust, let it grow, maybe you get a 7% return, 8% return on your money, and you collateralize that, get a bank loan, put that $1 million into an insurance policy, let it grow over 20 years. At the end of the 20 years, you're going to pay tax on everything that grew inside of your trust, but you're going to pay it with tax-free money from your insurance policy that you didn't even have to pay for out of pocket. That's how an extended escrow trust works. And, of course, sometimes we do it with the insurance component and sometimes we do it without. But that's a strategy that you can also use and leverage when you want to defer the tax on the sale. And we just had a conversation with someone just recently where they actually were selling a property, and if they would have realized all the tax today, they would have had a 40% tax rate. But because they don't have any income besides the sale, we just stretched it out where they received a little bit every year. We kept them in a 5% tax bracket, 5% tax bracket, and we didn't even have to do this whole insurance side of it. We avoided 35% of the taxes that they would have had to pay. That's pretty awesome, right? Actually, not 35% because 5% of 40% would have been, we avoided like 85% of the taxes that they would have had to pay, right? So, again, these are strategies that most people have never heard of. But now you have. If you know somebody that's exiting from a property, exiting from a business, these are options. The last option is what we call tax offset strategies. So we can do tax minimization strategies. They have to be done before you're under contract, before the sale happens. We can do tax deferral strategies up until the date of the sale, right? But what happens if you already sold the property? We got a call from someone last year, and they said, I sold the property, and we have a lot of capital gains. We want to see if we can avoid the taxes on it. And I said, wait, you're selling a property? They said, no, we sold a property. When did you sell the property? Oh, we sold it in January. Why are you just calling me in December? It's not the best time to do it, right? But fortunately, we still had options for them because we can still offset the taxes even though the sale already happened, as long as it's still in the same tax year. Christy's asking if I practice in Illinois. Our firm has attorneys in all 50 states that can assist. So yes, we can assist with clients in Illinois for sure. So how does a tax offset option work? Well, basically, you set up a structure that you can get tax deductions that will offset the amount of the tax that you're realizing. So we sell the property or the asset, we realize the tax, and then we offset it with deductions. You can have a private foundation, for example. If you have an operating foundation, an operating foundation. If you have an operating foundation, you can avoid up to 30% of the tax on your income. So you can put up to 30% of your income, and you get a dollar for dollar deduction for everything that goes into your foundation. If you have a non-operating foundation, Or if you have other charities that you can contribute to, you can actually avoid up to 50%. Used to be 60%, but up to 50% of your tax that you would be subject to. There are other strategies where, you can put your money into what's called a syndication, where instead of owning a property, you own a little piece of a property and you go in with a big institutional investor. They bring a bunch of money, you bring a little bit of money, right? You go in with them, and then they do what's called a cost segmentation study on the property, and they get a big loss that they push to year one, and then they give that loss to you so that you can declare it for your taxes. So a lot of times you can even get a dollar for dollar deduction or a dollar for dollar loss on your investment to be able to offset your taxes with. And of course, losses offset gains, right? So you avoid tax that way. But my personal favorite out of these is called a charitable lead trust. So how does that work? In essence, a charitable lead trust is kind of like the opposite of a charitable remainder trust. In a charitable remainder trust, you put the asset into the trust, and then when it sells, there's no tax, right? But then it gives you an income for the rest of your life. Well, in a charitable lead trust, it's the opposite. You put in money after the sale happens, and when the sale happens, the trust is going to realize the taxes, but it's going to avoid the first part of the tax because whatever goes to charity every year is going to be tax-free, right? So you have to set this up to give a certain amount to charity every year for a certain number of years. Most of the time we do the minimum, which is 5% over 20 years. 5% over 20 years, 5 times 20 is 100%, right? That's how you get a dollar for dollar deduction for what goes into the trust. So we put in however much, $100,000, whatever it is, right? You get a dollar for dollar deduction. And then inside of the trust, that money can be invested. So it's growing at 6%, 7%, whatever it is. Let's say it's growing at 7%. Then every year you're giving 5% to charity. So the difference is 2%. That's what you have to declare for taxes in the trust. But then the 5% that's going to charity could go to a public charity that you like, or it could actually go to your own private foundation that you establish and that you operate or help operate, or that you put family members in charge of operating, right? At the end of the 20 years, after all those payments have been made, whatever's in the trust, so this money's been accumulating, right? That's going to come back to you or to your family, whoever you name as your beneficiaries. So you don't actually have to give it all up. You're just giving up the income that comes from it, and not even all the income. You're just giving up the first certain amount of income, right? And when that money comes back to you, it's all post-tax money, meaning that you don't have to pay tax when it comes to you. So if you're exiting from a property and you have a whole bunch of potential capital gains exposure, and you don't really need that money right now, but you're going to use it for retirement, you put it in this type of structure, and for the next 20 years, you get to fund charitable activities that you can be heavily involved with and you can be in charge of and all that sort of stuff. And that can be fun, right? But then 20 years from now, you're going to have that money for retirement, and it's going to come to you tax-free, post-tax. So that's pretty cool. We've done a lot of these as well. The catch to this is, again, we're limited to the maximum amount that you can give. If you're doing your own private foundation, is 30%. Unless we supplement it with a public charity as a second beneficiary, then we can get up to 50%. But whatever you put in is a dollar for dollar deduction up to that amount. Sometimes we combine these strategies. We say, well, let's do a charitable lead trust and we'll do a syndication, and the combination of it will avoid 90% of the tax exposure. So again, these are things that people don't know about. So if you've ever known somebody that's paid too much in taxes, now that you know all this, let us know in the chat. Let us know if you wish that you would have known some of these strategies, that you wish you would have been able to tell them about some of these strategies. And this year, as you go around, you talk to people, you're going to find out that people have things going on. They're selling properties, they're downsizing, they're selling businesses, they're exiting, and they don't want to have to pay the tax. And we got solutions for them. And so, let us know. We're here to help. We can do the consultation. There's no cost for that. We can assist with putting things in place for these strategies that can minimize the taxes that they'd otherwise be exposed to. And then finally, again, we're not going to go into a lot of detail, but we can also help with estate tax planning. So when you pass away, everything you own is counted as part of your taxable estate for estate taxes. If it's over $12 million per person, then you're subject to, it starts at a 40% tax rate for estate taxes. Next year, 2025, this amount is going down to $5 million per person. So what does that mean? It means that this year is the time to talk to people who are between $5 to $12 million in net worth or above, because if they don't take advantage of it now, they will lose out on that $12 million exemption forever. This year is the most important time to have these conversations. But we can definitely avoid or minimize or plan around the estate taxes. We have a whole bunch of solutions for that, right? Irrevocable life insurance trust, qualified personal residence trust, intentionally defective grantor trust, grantor retained annuity trust. We're not going to explain all these tonight. I'm mostly saying that so that you know that we have tools in our tool belt and we know what we're talking about, right? But we can assist with those situations. So we're running up here on the hour. If you have questions, throw them in the chat, throw them in the the question and answer box. I know we have at least one question in here. Somebody asked, is there still time for a 2023 tax preparation? The answer is it depends, right? But at this point, we can't do proactive tax planning anymore. It's too late for that. You would have to do deduction planning with your CPA or with your tax professional, right? One other question was, how much income or assets should you have before you start tax planning? That's an excellent question. For income tax planning, proactive income tax planning, you should start no matter what income you're at. You should get a good professional helping you. But you might not need a tax attorney until you get to, multiple six figures, right? Or where your tax exposure is maybe, 20, 50,000 or six figures, that's when it's really going to benefit you the most to have a professional that can help you more than a traditional tax preparer or CPA, right? And when it comes to capital gains tax planning, these strategies, they're not cheap strategies. They have to be done properly. There's a lot of risk. There's a lot of, things that have to be done correctly. And you have to work with someone that really knows what they're doing. So they're a little expensive. They're usually in the range of, anywhere between $8,000 to $15,000 to implement, right? And if you don't have at least 250,000 in gains, then it probably doesn't make sense to pursue some of those strategies. Another question. My client sold 2 investment properties with a total of $2 million last year. Can we help her to minimize her tax? At this point, we can have a conversation, but we're not in the same tax year anymore, so probably not. But unfortunately, we'd have to coordinate with their CPA to see if there's any options. We can still talk to them, but it might be too late. Another question, what's the tax implications of a second mortgage that got charged off and the lien released? If you have any debt that's charged off, that could be considered income to you. And again, if you have to declare the income, then it's taxable that you're going to have to offset with deductions or with losses. So those are strategies that, again, we can look at. We can coordinate with your CPA. It's always best if we're in the same tax year, because if we're not in the same tax year, you might not have a lot of options. All right, last question. Do these work for people thinking to retire in another country? Of course, because if they're subject to tax in the United States, let's help them to minimize that tax exposure before they retire, and then they're going to live like kings. If you could save them $100,000 in the taxes that they would have to pay otherwise, I mean, that's big money wherever they're going to retire to, right? So let's make sure that we do that for them. So I promised you guys, we're here at the hour, we're going to wrap up. I promised you guys a special gift. Here it is. If you found value in what we talked about today, if you have somebody that you think would benefit from this conversation, from planning around the exit from a property or from a business, and you would like to convey the information that I just shared, and maybe you think, well, I don't know whether I can convey it 100%, and I don't know whether I can get on Glenn's calendar to convey it, I'm going to give you a tool. This is an ebook that we put together in conjunction with Sharon Lechter. Sharon Lechter is a renowned, author, coach, speaker, and she's written, I think, 32 best-selling books, including she was a co-author of Think and Grow. She was a co-author of Rich Dad Poor Dad. She was a co-author of Cash Flow Quadrant. She was the author of Think and Grow Rich for Women. Right? She ghost wrote, or actually not ghost wrote. She edited How to Outwit the Devil. Right? And so she is super famous. And I had the privilege, along with Sir John Shin, to visit with her one day. And we were having a conversation, and she had written a book called Exit Rich. And it's about business owners who want to exit and preparing their exit so that they get the most money for their exit when they sell their business. And I read through the book, and I told her, I like the book, but where's the chapter on tax planning for the exit? She said, we didn't include it. So I said, well, what if we wrote it together? And then we could have that as an option to give out to people who are thinking about the exit. And if they like, the idea of planning around it, then they can go and get your book and they can read more about it. She said, well, that's a great idea. So we wrote it, and we have it as an ebook, and that's my gift to you. If you're interested in receiving it, I want you to email our professional development coordinator, who's called Drew Berman. His email is drew@lspnpro.com. Email him and let him know that you would like to receive a copy of Planning Your Tax-Free Exit. And he's going to reach out to you and coordinate getting you a copy of the ebook. And this is a gift that you can use for you. But as you have conversations with clients, you can share it with them so that they can get a little bit of this information before they sit down with us. And then we can actually help them to implement the options that make sense for them. So this year is all about empowering you with tools, helping you to be able to get more sales and have more success. We're here as a support, as an option, and as a resource for you. If you haven't registered with us, go to lspndirect.com, register with us. It's easy. It's super easy to register. If you send us any clients and we end up helping them, you actually get credit. And so we want you to be able to have success. We want you to be able to make money. And these are options. These are strategies that when we help the client, it's a win-win-win. And these are big, big, big money strategies that are going to save the client a lot of money, make you a lot of money, and help us to be able to really make a difference. So thanks again for joining us tonight. I'm going to go ahead and wrap up. Again, somebody asked if we speak Spanish. Yes, we have a Spanish team. We can help in Spanish as well. So thanks again for joining us this evening. Hopefully this was valuable for everybody. We'll talk to you all very soon.